Let's talk about the revenue recognition principle. To ensure consistency and compliancy within companies' accounting procedures, the Australian Accounting Standards Board have developed the GAAP, the Generally Accepted Accounting Principles, which are the standards, rules, principles and procedures that govern the field of accounting. One of these principles is the revenue recognition principle. In accounting, there are two possible bases for recording revenue: the cash basis of accounting and the accrual basis of accounting. Generally accepted accounting principles require the accrual basis, as it is an application of both the revenue recognition and matching principles, and it provides a better representation of income over a period of time. The accrual basis of accounting records revenues when they are earned and expenses when they are incurred. Before we delve further into what the revenue recognition principle is really about, let's meet Jane. Hi, Jane. Jane has her own photography business. Jane agrees to photograph your 21st birthday party in October for $400. Jane completes the service on the 29th of October, bills you, and receives your payment on the 3rd of November. So when did Jane earn her revenue and when will she record it? That's where the revenue recognition principle steps in. A revenue is an increase in resource resulting from the sales of goods or the provision of services. In Jane's case, the revenue is the $400 she has earned from photographing the event. Revenues are recorded according to the revenue recognition principle. Because the exchange of cash does not always coincide with the earning of a revenue, the principle states that a revenue should be recorded when a resource has been earned, not when cash is received. A resource is earned when either the sale of the good or the provision of the service is completed and collection is reasonably assured. Therefore, in Jane's case, her $400 service revenue must be recorded on the 29th of October when the service was completed and the revenue was earned. This is known as an accrued revenue. An accrued revenue is when a company earns revenue before cash is received, also known as a receivable. Contrastingly, if you had paid Jane before she photographed your party, Jane would have had a deferred revenue. This is when a company receives cash before they earn the revenue. Because at the time you paid Jane, she had not provided the promised service, she cannot record this as a revenue and must record it as a liability. So in summary, the revenue recognition principle is one of the generally accepted accounting principles and states that revenue must be recorded when earned, whether cash is received in advance or cash is received after the service.